Morning. My name is Bob Shea. I am the CEO and Chief Investment Officer of FCF Advisors, formerly TrimTabs Asset Management. And I just wanted to take 5 minutes. I could definitely speak for an hour plus on macro and markets, but I wanted to give a very high-level overview and share some thoughts on what's gone on and where we're at now. When I joined the company in Jan 2020, I was fairly outspoken in saying that I thought that at the time, mega cap tech stocks were really on a tear. But my strong feeling was that the real bubble in asset markets was in the bond market. At the time, there was some $17 trillion in negative yielding debt, and that the 60-40 portfolio, which had worked just incredibly well throughout the post-Great Financial Crisis period, the 40 was really going to be the main issue. That's certainly playing out as starting last year, that negative yielding number has moved from 17 trillion down to $2 trillion. Just to keep on the bond market, it was a rather eventful week in the bond market. 10-year notes yields rallied 33 basis points for the week to close at 270, and up 95 basis points from just the beginning of March. As you know, what's driving that? The Fed, as we know, controls the front end of the yield curve, and markets control the back. And the Fed has been pretty unambiguous and unified in their desire to move from transitory notion to fighting inflation at all costs. So that has driven the front end up for 2 weeks leading up to last. We were hearing all about yield curve inversions. I will spare you that and what that means for markets. We could talk more about that in our webinar at the end of the month. But I just really wanted to talk about big picture again. It's really and the Fed has been resolute in looking to fight inflation. And that notion of transitory is gone. So I think allocators are really definitely the degree of difficulty has gone up. And what could possibly be, on the long end rates went up this week and yield curves uninverted, mostly because of Lael Brainard's comments about balance sheet runoff. Obviously keeping supply pressure on those yields and those prices, as well as the market already looking to past the very aggressive and quick tightening cycle to more easing. The Fed raising interest rates rapidly isn't going to solve the supply chain issues and the inflationary pressures that are on the immediate horizon. But it could eventually cause some demand destruction, and the big talk is that they're going to force a recession. What could be the flip side to that very pessimistic view? And again, the inflationary pressures that were embedded and resulting from all the monetary and fiscal stimulus, post-pandemic stimulus, has been exacerbated by the war in Ukraine and that tragedy. What I think, what could possibly ease some of that? Well, China lockdowns certainly aren't helping. I don't have an insider view on when that may abate. It's certainly the news flow over the weekend isn't anytime soon, and or peace in Ukraine. And again, I think sanctions will be embedded for some time. And so I think that's kind of what could possibly bring inflationary pressures down. But the war in Ukraine definitely exacerbating and making the inflationary pressures bigger. I think what we're dealing with is, and as you know, recessions cause bear markets, not inflation. And I don't think that recession is a 22 or even 2023 high probability, but what it feels like is cycle compression. So if you remember, it felt like we were at some very late cycle in 2020 leading into the pandemic. with a lot of mega cap tech platform leadership, and that quickly led to the COVID crash, recession, and an equally violent recovery period coming out with the the monetary and then fiscal response brought us back into a recovery, and then kind of a mid-cycle with 2021, really favoring factors like free cash flow, profitability, what we focus on, and free cash flow yield. And now there's a lot of talk and fear about recession. What's interesting, I still think the problem is in the bond market. Bond volatility, rates volatility is 5x that of equity volatility. I think equities have hung in there pretty well, and I think are looking forward to earnings. I think positioning is pretty benign, as measured by a number of surveys I saw over the weekend on prime brokerage. That in itself is not a bull market thesis, but I think folks have moved very quickly into the recession camp, and I think that'll take time. What I do think the headwinds for investors going forward are going to continue to be, as we have an energy shock that has morphed into an energy crisis. Energy markets were already tight going into the Ukraine war, and have been exacerbated with the prices of oil, natural gas, and coal up anywhere between 100 and 500% from 2021, early 2021. I think another very big picture headwind is deglobalization. That's been in place and in motion. It's been receding for the better part of 5 years, with the combination of Brexit and Trump and China tech wars. And again, I think the Ukraine war is going to be accelerating that as countries look to bring supply chains onshore, shortening them, as well. That's going to add to capex pressure, as well as margin pressure, and definitely not going to help the inflation backdrop. So energy shock turned crisis, the power of deglobalization, and then tighter central banks around the world. As we know, central banks are also quite unified, in the major central banks, in fighting inflation. So they are not going to be there to buy the dip, and that's a headwind. Looking forward, maybe the midterm elections, where tighter monetary also leads to tighter fiscal, depending on the outcome. But there's no shortage of headwinds that investors have to navigate in this environment. And I think, again, the bond market is the real issue and the stress for allocators and investors alike. I think really being selective in your equity exposure is super important. What I think is going to continue to work, a real asset equities with yield. I like profitable innovation, companies that can fund that innovation with free cash flow. And we focus on free cash flow profitability, companies with very strong and sustainable profitability that really do have pricing power. So I think that is a very high level thoughts on where we are. Again, you can find more information on the FCF Advisors website, where we'll post this video, and I look forward to talking to everyone in greater detail with charts in a webinar at the end of April. Thank you again.